Welcome to the Macroeconomic and Financial Commentary podcast. I am your host from the Macro Research team. This week, we're tracking three interconnected stories that paint a picture of significant transition in the global economic landscape. First, we'll explore how the US dollar's precipitous decline to levels not seen since March 2022 reflects growing market conviction that the Federal Reserve is poised for a dovish pivot. Despite official pushback from policymakers, this currency movement isn't occurring in isolation. It is accompanied by internal divisions within the Fed itself, regulatory reforms aimed at Treasury market stability, and mounting speculation about Fed chair succession that could reshape monetary policy well into 2026. Our second focus examines the transition from geopolitical shock to economic fundamentals. The recent Iran-Israel ceasefire has removed critical risk premiums from markets, but this calm is revealing underlying vulnerabilities in inflation dynamics and exposing the fragility of current economic cycles. We're seeing manufacturing cycles accelerate faster than anticipated, semiconductor overcapacity emerging, and what appears to be the early stages of a demand-led deceleration that could define the first half of 2026. Finally, we'll turn our attention to Hong Kong, where the Hong Kong dollar's movement to its weak side peg limit has triggered the first HKMA intervention since May 2023. This development signals broader liquidity dynamics at play, with ultra-low HIBOR rates fueling equity rallies and carry trades that may soon face pressure as Fed policy shifts. These aren't isolated developments, they're interconnected pieces of a larger puzzle that speaks to the current state of global financial markets as they navigate between policy uncertainty, economic transition, and the ongoing recalibration of risk premiums across asset classes. Let's begin with our first major topic, the dramatic decline in the US dollar and what it reveals about market expectations for Federal Reserve policy. The data we're seeing this week tells a compelling story about the disconnect between official Fed communications and market pricing. The US dollar index has dropped to 97.23, marking its lowest level since March 2022. To put this in perspective, that represents a full 10% decline year to date, a significant move for the world's primary reserve currency. This isn't a gradual drift we're observing. It is a sustained sell-off that reflects fundamental shifts in how markets are positioning for Fed policy. What makes this particularly noteworthy is the speed at which non-dollar currencies have strengthened. The euro has climbed to $1.1745, while the British pound has reached $1.377, both hitting their highest levels since 2021. These moves signal broad-based dollar weakness rather than isolated currency-specific strength, indicating that the dollar's decline reflects changing expectations about U.S. monetary policy rather than idiosyncratic factors affecting individual currencies. The futures market data provides crucial insight into market thinking. Markets are currently pricing in 64 basis points of rate cuts for 2025, a figure that stands well above the Fed's own projections. Perhaps even more telling is the spread between year-end 2025 and 2026 U.S. rate futures, which has widened to 65 basis points from just 35 basis points 3 months ago. This widening spread signals that traders see not just near-term cuts, but deeper cuts extending into 2026. Our analysis indicates this represents more than typical markets, Fed divergence. The sustained nature of the dollar decline, combined with the breadth of currency moves, suggests markets have developed strong conviction that the Fed's current stance is unsustainable given evolving economic conditions. This conviction is forming against a backdrop of significant internal debate within the Federal Reserve itself. Our research reveals a clear factional divide that is emerged within the Fed, centered around how to interpret and respond to the unprecedented nature of current tariff levels and their economic implications. The wait-and-see faction raises compelling concerns about the current tariff environment, with effective tariff rates now at 15% Fed compared to less than 2% during the 2017 to 2018 period. Fed officials in this camp argue that we're operating in uncharted territory. Their position is that the magnitude and complexity of current trade policy creates unpredictable inflationary pressures through supply chain interactions that historical models simply can't capture effectively. From their perspective, the prudent approach is to maintain current policy stance until these effects become clearer. Opposing this view is the time is ripe faction, which includes some traditionally hawkish voices who have recently turned more dovish, notably Governor Waller. This group focuses on labor market dynamics and views tariffs as essentially a one-time shock that monetary policy should look through, regardless of timing. Their analysis emphasizes that current labor market conditions, with normalized vacancy to unemployment ratios, present minimal risk of secondary inflation effects from any policy easing. What is particularly interesting about this divide is how it reflects broader questions about monetary policy in an era of heightened trade tensions. The wait-and-see faction's concerns about tariff unpredictability aren't merely technical they reflect genuine uncertainty about how traditional monetary policy transmission mechanisms function when trade policy becomes a dominant economic force. The balanced labor market conditions that the time is ripe faction points to do indeed support their case for preemptive easing. Current data shows vacancy rates have normalized from their post-pandemic peaks, and unemployment levels remain consistent with historical definitions of full employment. This suggests the economy has room to absorb modest policy accommodation without triggering wage price spirals. However, the Federal Reserve isn't just grappling with policy divisions. Fed is also implementing significant regulatory reforms that could reshape Treasury market dynamics. Last Wednesday's vote to ease the enhanced supplementary leverage ratio rule represents a substantial shift in banking regulation with implications that extend far beyond the immediate policy change. The ESL rule, originally designed as a backstop measure, has become a binding constraint on major banks' ability to hold low-risk assets like U.S. Treasuries. Our analysis of the data reveals that from Q2 2021 to Q4 2024, GSIB depository subsidiaries were bound by SLR rules 87% of the time. This constraint has contributed to a steady decline in primary dealer participation in Treasury auctions since 2015, effectively undermining banks' ability to serve as intermediaries in the Treasury market. The Fed's proposal to lower GSIB ESLR requirements from 5% to 3.5 minus 4.25% would release an estimated $226 billion in total capital, $13 billion from GSIBs themselves, and $213 billion from their subsidiaries. This capital release would enable banks to hold an additional $1.1 trillion in low-risk assets, primarily U.S. Treasuries. The significance of this reform extends beyond the immediate numbers. Historical precedent suggests that regulatory relaxation of this magnitude could meaningfully suppress Treasury market volatility and improve liquidity conditions. Given concerns about Treasury market functioning during periods of stress, this reform addresses structural issues that have been building for years. The timing of this regulatory shift, combined with the internal Fed divisions we've discussed, creates a complex backdrop for monetary policy decisions. Markets are interpreting these moves as signals that the Fed is preparing for a more accommodative stance, even as official communication suggests otherwise. Adding another layer of complexity is the growing speculation about Fed chair succession. Markets are increasingly pricing in the possibility that a new Fed chair could be named as early as September or October 2025, well ahead of Jerome Powell's May 2026 term expiration and earlier than the typical announcement timeline. Current prediction markets show Kevin Warsh leading with a 26% chance, reflecting his close personal ties to the Trump administration. However, Warsh's historically hawkish stance creates interesting dynamics. Trump's preference for more dovish monetary policy could work against Warsh despite his personal connections. Scott Bessent follows closely at 21%, with his Wall Street background and recent addition to Trump's team, boosting his odds significantly. The no announcement option sits at 22%, which itself tells us something about the uncertainty surrounding this decision. Chris Waller at 17% and Kevin Hassett at 14% round out the leading candidates, with Hassett's dovish views and current White House role potentially making him a more serious contender than his current odds suggest. This succession uncertainty compounds the policy transition risks we're already seeing. The combination of internal Fed divisions, regulatory reform, and leadership speculation creates a perfect storm of uncertainty that markets are struggling to price efficiently. The Q3 2025 period emerges as a critical window where these various factors could converge to create significant policy shifts. The dollar's decline against this backdrop makes more sense when viewed through this lens of compounding uncertainties. Markets aren't just betting on rate cuts, they're positioning for a potentially fundamental shift in Fed policy approach that could emerge from this confluence of factors. Now let's shift our focus to how recent geopolitical developments are reshaping market dynamics and revealing underlying economic vulnerabilities that were previously masked by risk premiums. The Iran-Israel ceasefire has created what we might call a false dawn, a period of apparent calm that is actually exposing more fundamental economic challenges. The removal of geopolitical risk premiums has stabilized oil prices in the $65, $75 range, but this stabilization is creating new challenges for inflation dynamics. Our analysis shows that as oil price comparisons are shifting from $80 per barrel averages in the first half of 2024 to $70 in the second half of 2025, and we're projecting $65 in the first half of 2026. While lower energy costs typically support economic growth, the timing of these changes is creating base effect vulnerabilities that could complicate the Fed's inflation targeting. The concern here is that core PCE inflation becomes more susceptible to upside pressure, just as economic growth shows signs of deceleration. This creates a challenging environment where the Fed might face rising inflation pressures, even as other economic indicators suggest the need for accommodation. Our projections indicate that core PCE inflation will remain elevated at 2.9% to 3.1% in the second half of this year, supported by these stable but still elevated oil prices post-ceasefire. Global equity markets have nearly rebounded to the 2nd of April tariff levels, with the S&P 500 gaining 3.1% in June alone. However, this recovery is occurring against the backdrop of persistent dollar weakness, which reflects what we're observing as diminishing market confidence in the sustainability of current trade policy approaches. This market recalibration allows focus to shift toward fundamental economic drivers, particularly the Fed's retained easing capacity under Taylor rule analysis. Our models suggest the Fed maintains room for 225 basis point cuts if oil stabilizes at $65, and space for 1 to 2 cuts at $75 levels. This translates to a conditional PCE inflation target near 3%, way higher than the Fed's traditional 2% target, but potentially acceptable given current economic conditions. What is particularly significant is how this differs from the 2018 tightening cycle. Unlike that period, the Fed's current stance avoids the need for rate hikes, which provides crucial support for growth during what appears to be a transitional period in the economic cycle. However, the apparent calm in markets is masking significant underlying tensions in Trump administration trade policy. Our analysis has identified what we see as three major contradictions that are increasingly apparent to market participants: dramatic tariff hikes versus the need for negotiating leverage, debt default threats versus the imperative to preserve dollar hegemony, and the theatrical nature of legal diplomacy versus the need for substantive economic outcomes. These contradictions have led markets to recalibrate expectations away from shock headlines toward actual implementable policy outcomes. The bilateral negotiation progress we're tracking across various trading partners reveals significant variations in diplomatic outcomes that illustrate these challenges. What is revealing about these bilateral negotiations is how they demonstrate asymmetric leverage challenges. Larger economies like the EU are maintaining more resistant positions, while smaller nations face binary choices between us and Chinese spheres of influence. This asymmetric bargaining dynamic prevents the development of trilateral frameworks that might provide more stable, long-term solutions. Countries lack middle ground positioning options that would enable the trust building necessary for complex multilateral arrangements without shared concessions across multiple issue areas. The current approach creates inherent instability that markets are beginning to recognize and price accordingly. This brings us to a critical observation about manufacturing cycles and their implications for the broader economy. The tariff-induced restocking that peaked in April 2025 has effectively exhausted demand and is now driving a manufacturing downturn. U.S. retail sales turned negative in May, a clear signal that the consumer spending that typically sustains economic expansion is beginning to weaken. Taiwan's export data provides a particularly clear window into these dynamics. Exports surged 38% year-on-year to $50 billion in May, but our forecasts suggest this will stagnate by the first half of 2026. This aligns with broader indicators suggesting that the manufacturing cycle acceleration we've observed is actually revealing earlier than expected peaks and subsequent downturns. The semiconductor sector faces particular challenges as AI-driven demand slows post-front loading. Taiwan's ICT export orders are projected to decline, mirroring the post-peak contraction we observed in 2018. This inventory buildup threatens us tech markets that rely heavily on global supply chains, creating potential corrections in a sector that has been a key driver of market performance. Global inventory declines signal broader economic deceleration that extends beyond manufacturing into services and consumption. The interconnected nature of current supply chains means that regional manufacturing slowdowns quickly translate into global demand weakness. Looking ahead, our analysis suggests that economic growth will weaken significantly in the first half of 2026 as restocking effects fade. Taiwan's export stagnation reflects global demand decline, while semiconductor overcapacity risks major corrections in the tech sector. U.S. retail sales turning negative in May combined with new home sales under pressure signals consumer weakness that could amplify deceleration risks. However, it is important to note that R&D investments in AI and nuclear energy continue to offer long-term productivity gains. The question is whether these investments can offset near-term cyclical weakness. U.S. economic exceptionalism, the ability to maintain growth leadership fate increasingly depends on breakthrough developments in trilateral trade arrangements that currently seem unlikely. Currency volatility is intensifying as global central banks increase gold allocations, reflecting broader concerns about the stability of the current international monetary system. While U.S. Treasuries still hold value, supported by the regulatory reforms we discussed. Earlier faked we're observing a clear flight to gold amid broader dollar weakness. Neutral markets like India are gaining from US-China tensions, positioning themselves as alternative destinations for investment and trade. Defense stocks and AI investments remain resilient, reflecting the strategic importance of these sectors regardless of broader economic conditions. This is reshaping portfolio allocations as investors seek assets that can perform well even as Fed easing attempts to offset growth headwinds. Our final major topic takes us to Hong Kong, where currency peg dynamics are revealing broader shifts in global liquidity conditions and their impact on regional markets. The Hong Kong dollar's movement to its weak side limit represents more than a local currency adjustment. Fate is a signal of changing capital flows and monetary conditions that have implications far beyond Hong Kong's borders. This week, the Hong Kong dollar hit the weak side limit of 7.85 against the US dollar, prompting the Hong Kong Monetary Authority to intervene for the first time since May 2023. On the 26th of June, the HKMA bought HK$9.42 billion to defend the PEC-FEI, a substantial intervention that underscores the pressure the currency has been facing. What makes this particularly interesting is the sharp reversal we've observed. Back in early May, the HKD briefly touched the strong side level of 7.75 to maintain the peg at that time. The HKMA sold HKD and bought USD, injecting local currency into the system. This action had an unexpected consequence. It pushed HIBOR sharply lower and ultimately weakened the HKD toward the current 7.85 level. The magnitude of the HIBOR movement has been dramatic. Overnight HIBOR dropped from 4.50% to nearly 0%, while one-month HIBOR fell from 4.07% to 0.52%. After this week's KMA intervention, it bounced slightly to 0.75%, but these levels represent a fundamental shift in Hong Kong's monetary conditions. Under the linked exchange rate system, The HKMA maintains the HKD within the 7.75 minus 7.85 range through liquidity management. What we're observing now is how this mechanical system can create feedback loops that amplify rather than dampen currency pressures. The initial intervention to defend the strong side created conditions that ultimately required intervention on the weak side. The ultra-low HIBOR environment has created compelling opportunities for carry trades. The overnight SOFR-HIBOR spread has reached 428 basis points, while the SHIBOR-HIBOR spread has widened to 140 basis points. These differentials are attracting investors who can borrow at ultra-low HIBOR rates to invest in higher-yielding assets, including equities. This carry trade activity is contributing to HKD weakness by increasing demand for other currencies, but it is also fueling significant capital inflows into Hong Kong's equity markets. Year to date, southbound flows have reached RMB 723 billion, nearly matching last year's full year total of RMB 808 billion. This represents an acceleration of capital flows from mainland China that has been a key driver of Hong Kong market performance. The cheap HKD funding has lifted the Hang Seng Index by 8.4% since May, demonstrating how currency dynamics and equity performance can become interlinked through liquidity conditions. The surge in mainland Chinese investment reflects both the attractive funding conditions and the relative stability of Hong Kong markets compared to domestic Chinese alternatives. However, our analysis suggests this dynamic may be approaching a turning point. If the HKMA continues to intervene at the weak side convertibility undertaking and drains liquidity, the aggregate balance will decline, prompting a rebound in HIBOR. Historical data shows a strong negative correlation between 3-month HIBOR and the Hang Seng Index, suggesting that rising interbank rates typically exert downward pressure on the equity market. Rate-sensitive sectors such as property, utilities, and REITs are particularly vulnerable to rising HIBOR. These sectors have benefited significantly from the ultra-low rate environment, and any normalization of borrowing costs could create substantial headwinds for their performance. The Federal Reserve's expected rate cuts in the second half of the year add another layer of complexity to these dynamics. A narrowing HKU's interest rate spread could push the Hong Kong dollar toward the strong side of the trading band, reversing the current weakness. While this might seem positive for currency stability, a stronger HKD could actually reduce capital inflows into the local market, creating different pressures on Hong Kong equities. This creates a challenging environment for Hong Kong policymakers and investors. The current ultra-low HIBOR environment is unsustainable and will likely face pressure from either HKMA interventions or Fed policy changes. Either scenario could dampen the equity market performance that has been supported by current liquidity conditions. The broader implication is that Hong Kong's role as a financial center continues to be shaped by the interaction between its currency peg, mainland Chinese capital flows, and U.S. monetary policy. The current episode demonstrates how these three forces can create periods of significant opportunity, followed by periods of adjustment that require careful navigation. Our analysis suggests that investors should be prepared for increased volatility in Hong Kong markets as these dynamics play out. The liquidity-driven gains of recent months may give way to more challenging conditions as monetary authorities on both sides of the Pacific adjust their policies to address changing economic conditions. Before we conclude today's analysis, let's look ahead to the key economic events coming this week that will provide further insight into the trends we've been discussing. On the 1st of July, we'll receive both US and China PMI data. The US PMI is expected to remain at 48.5, which would mark a fourth consecutive month of manufacturing contraction. This persistent weakness raises concerns about industrial output and broader economic slowdown risks. We'll be monitoring high-frequency indicators, particularly new orders, as they often provide early signals of whether the contraction is deepening or beginning to stabilize. China's PMI is forecast to edge up to 49.7 from 49.5, but this will still leave it in contraction territory despite the temporary export boost from recent tariff adjustments. Limited demand improvements suggest ongoing challenges in the Chinese economy, with significant implications for global trade flows and commodity prices. months. The 3rd of July brings us crucial U.S. employment data. Non-farm payrolls are expected to slow to 116,000 from the previous 139,000, while unemployment is projected to rise to 4.3% from 4.2%. Rising jobless claims and high challenger numbers suggest the labor market is cooling, which could pressure consumer spending, a key concern given the retail sales weakness we discussed earlier. Wage growth trends will be particularly important for the Fed's inflation outlook and policy decisions. Also, on the 3rd of July, we'll see the U.S. Services PMI, anticipated to rebound to 50.4 from 49.9, entering expansion territory, as services consumption appears to be holding firm despite tariff impacts on goods. A stronger than expected reading could bolster confidence in economic resilience, while a miss may signal that broader slowdown risks are beginning to affect the services sector as well. These data points will provide crucial evidence for the various scenarios we've outlined today. Weak manufacturing data combined with softening employment could strengthen the case for Fed easing, while services resilience might support the argument for patience. As we wrap up this week's commentary, let's step back and consider the broader picture that emerges from our analysis. We're observing a global financial system in transition, where traditional relationships between currency movements, monetary policy, and economic fundamentals are being tested by unprecedented policy conditions. The US dollar's 10% decline this year isn't just a currency story, it is a reflection of markets grappling with Fed policy uncertainty, internal divisions among policymakers, and the complex interplay between trade policy and monetary policy. The Federal Reserve faces a unique challenge. Internal factions disagreeing on how to interpret unprecedented tariff levels, regulatory reforms needed to support Treasury market functioning, and succession uncertainty that could reshape policy direction. Markets are positioning for a more dovish Fed despite official resistance, creating the potential for significant volatility as these expectations either converge with or diverge from actual policy outcomes. The post-ceasefire period has revealed economic vulnerabilities that were previously masked by geopolitical risk premiums. Manufacturing cycles are accelerating faster than expected. Semiconductor overcapacity is emerging, and demand-led deceleration appears to be taking hold. These dynamics suggest that the first half of 2026 could be challenging for global growth, even as long-term investments in AI and defense technologies continue to offer productivity gains. Looking ahead, the key themes to watch are the resolution of Fed policy uncertainty, the sustainability of current trade policy approaches, and the ability of technological investments to offset cyclical economic weakening. The Q3 2025 period emerges as particularly critical, with potential Fed chair succession decisions, ongoing trade negotiations, and evolving economic data all converging to shape the direction of global markets. Thank you for joining us for this week's macroeconomic and financial commentary. I am your host from the Macro Research team. We'll be back next week with our continued analysis of global economic and financial developments. Until then, stay informed, stay analytical, and remember that in markets as complex as these, understanding the interconnections between seemingly separate developments often provides the most valuable insights.